Welcome to Catalyst, everyone. I'm Brad Smith. 30 minutes into the U.S. trading day. Let's get to it. 3 catalysts that we're watching this hour. First up, oil prices pull back after surging to their highest level since January last week. We'll get the insight on the outlook for the sector. Plus, defense stocks continue their climb higher as the Israel-Iran conflict enters its 4th day. We'll have full coverage on that ahead. And investors eye potential trade talks as President Trump and other world leaders, they head to the G7 summit in Canada. All that and more coming up on Catalysts. Half an hour into the start of the U.S. trading day, let's get a check of the markets. Right now, taking a look at the major averages to begin, we're seeing gains across the board, and we're higher than where we began today's trading session. We saw fractional gains at the opening cross here, and as of right now, we're up by 1% across all 3 of the U.S. major averages, the Dow, the S&P 500, and the NASDAQ. Let's flip on over to the bond market, take a look at where yields are moving right now. The 5, the 10, and the 30-year all seeing some slight gains here this morning. Watching that closely, as well as some of the next key catalysts here that the market is paying close attention to. And that's the big question. What is the next key catalyst for the market rally? I want to bring in my guest contributor for the hour. We've got Jessica Inskip, stockbrokers.com, Director of Investor Research. Great to have you here on set with us today.
So happy to be here. Thank you so much.
Absolutely. So let's dive into what we're seeing right now play out in markets as there's a little bit of the fading of what the initial shock was on the back of the conflict that broke out at the tail end of last week. Now we're seeing gains across the board to begin the session. There seems to be more focus on what the trade negotiations might look like. Oh yeah, and it's an FOMC meeting week too.
It is a big week, yeah.
What do you think is taking the most priority right now?
Yeah, so we definitely need some clarity, but because of the week, it's absolutely the Fed and understanding where their commentary is coming from and how they're feeling about the data, because ultimately they're the ones making the decision. So we're getting also a SEP this week, so understanding where they feel growth is happening, how they feel about the unemployment picture, how they feel about the inflation picture is going to give me an idea of the balance of risks. That to me is the biggest catalyst in the market. But what I think is so important, especially because I'm here on a Monday, whenever we start the week, I like to think about the setup. We're coming in where earnings season took us over what I like to call the tariff ceiling of uncertainty. Okay. When we first had tariffs introduced, the first one actually put into place was on January 3rd, and that was around 59.68. We can call that maybe 5,900 if you want, 6,000. Sure. But we overcame that area due to earnings. So now that's our area of support, which tells me market action is saying, okay, tariffs are not so much of the concern as they were, may not spur as much volatility as long as we stay above that line. And now we're shifting more to Fed policy, earnings, and anything that could impact that earnings picture.
And so you had a note within your own kind of outlook right now, and it was centered around valuations. And I want to dive in on that because you had actually made the argument here that people argue stocks look expensive compared to long-term averages, but they ignore how different we are comparatively to previous market cycles as well. Why is that?
Absolutely. And I think there's even this trend going on TikTok where it says passive indexing, index fund and chill, if you will. Yeah. So always stay in the S&P 500. What people don't understand or seem to miss is the S&P 500 is a self-cleaning machine. It changes. Yeah. Even if we go back to when we're comparing it to historical averages from PEs and things of that nature, it was mainly industrials and manufacturing. Now we've shifted so much more into the technology phase, but not only, which also justifies higher PA valuations, because what always has higher PE valuations is technology because of the earnings growth. But diving deeper, there are larger profit margins than there were before. There's actually higher free cash flow per share, and there's more earnings growth capability. So comparing it is apples to oranges, not apples to apples. And I think valuations are absolutely justified because of the different market structure of the S&P 500 versus those historical averages.
We also know that companies don't need to come out this next earnings season, as many of our guests have pointed out, and sound the all clear on the uncertainty when they haven't gotten the answers that they're looking for in trade across some of the key regions that they operate and have partners here. So what is that setup looking like as correlated to valuations if we have companies come out and say, hey, you know what? We still don't really have too much clarity that would allow us confidence to give you guidance going into the back half of this year and for the rest of the back half of this year.
Well, if anything, it gives catalyst. One, it does spark more volatility because volatility and uncertainty go hand in hand. But analysts are, of course, bringing earnings targets down. And when that happens, we have a lower bar that we can absolutely exceed, which is why we usually do very well every earnings season. But we can focus on the knowns. Like we've got a little more IPO activity coming in.
Thank goodness.
Yeah, right, absolutely. And the AI narrative is coming back to life. So we can filter in the knowns. Hopefully we'll get a little more clarity of how at least the Fed is seeing tariff policy with inflation. And I think we can get that with the dot plots if we just pull together how they see growth versus inflation and the impact on unemployment. Putting that balance together and seeing where the balance of risks fall, I think is going to be so important.
One of the areas that you're bullish about is energy within the context of the AI trade. Why is that?
Well, because we have a very large energy problem. We are putting so much pressure on the grid and we're expanding that. And we always need to follow where money is being spent. We have larger CapEx spending within all the hyperscalers. But what's really interesting is they're getting very creative right now. So even this have you heard of behind the meter?
Behind the meter. Behind
the meter. So it's where we're not plugging, we're taking these older, the uranium is used for those centers, but they're not going directly into them. They're going on other sides of it. So it's a way to impact the grid. But then the issue is that's giving them more electricity. But anyone in that local area could have more electricity cost for anyone who lives locally there.
Okay. I have an idea that I'm going to be learning some more stuff throughout this hour.
That's going to be great.
Let's pause the conversation there because we do want to stay with the energy conversation for a hot second here. Oil pulling back after topping $77 per barrel overnight as conflict in the Middle East continues for a fourth day. Joining me now, we've got Patrick DeHaan, who is the gas buddy, head of petroleum analysis. Patrick, always a pleasure to grab some time with you. Thanks for joining us here on Yahoo Finance. What are you expecting as volatility continues in the oil markets?
Yeah, good morning. Great to be with you. Well, it's going to be a little bit of a volatile ride here for consumers. Probably we will see some minor increases in gas prices, probably along with diesel. Airlines also likely to see an increase in jet fuel prices, all of this stemming from oil prices that did surge late last week. But now just word breaking a few moments ago that Iran may be signaling that it wants to tone down tensions and work back to nuclear talks. Oil prices now have just fallen back below $70. So consumers probably are still likely to see an increase in gas prices related to last Friday's climb. But highlighting these headlines and uncertainty obviously is a little bit tricky. Obviously, market's very sensitive to Iran being an oil producer. The Strait of Hormuz obviously could still be involved. So these developments could lead to a little bit of a jump at the pump here. Gas prices still relatively minor or tame, I should say, over the course of the summer season. So far, gas prices still about 33 cents a gallon below last year, but look for an increase now. We might get some decreases, though, coming back ahead of July 4.
You know, with that in mind, Patrick, we know that some tanker owners, they are trying to navigate around the Persian Gulf, citing security risks. How much of a knock-on effect could that have on prices?
Yeah, that certainly could delay some of those tankers by taking another week or two to get around Africa. So keep an eye on that. And, right now when OPEC has been producing more oil, that could be a little bit more problematic, introducing some delays into the system. So, obviously, tankers are not going to want to wade through the Strait of Hormuz, given the tensions right now. So to your point, that's kind of one of the collateral damages of this latest barrage of attacks between Israel and Iran. All in all, I think Iran, on the surface of this, the calculus shows that they don't have a lot of terrific options here. And I think the market already had sensed that overnight. WTI and Sunday night trading had shot up 5% at one point, but earlier this morning had tapered off. And that's because Iran just really doesn't have a whole lot of options here. And that is, in a way, reducing the risk. Now, of course, as I mentioned, breaking news that they may be coming back to the table now, oil prices even lower. So just a tremendously volatile situation, just highlights the uncertainty of oil markets. When something happens in a major oil producer, it can affect us globally.
And so with that in mind, we know that even for companies like Baker Hughes, they came out and said everything is operating as normal, but it also elucidates something more large, which is all of the energy companies that are trying to figure out, okay, how much more difficult this makes forecasting for them. What's your read through?
Yeah, absolutely. We've been looking at hostilities in the Middle East ever since Hamas attacked Israel back in, I think, late 2023. So it just highlights the uncertainty of this area of the world. And it's still probably going to be a little bit tricky to try and navigate this moving forward. There's always the potential that these situations could escalate again in the future, especially with the campaigns ongoing now for the last couple of years. But I think, as I mentioned, Iran is running low on munitions. I think there's going to be a lot of challenges here for Iran moving forward that, in a way, could start reducing some of the risk moving forward. So we'll have to see. But at the end of the day, this is still a volatile area of the world, and certainly could be prone to some very significant uncertainties. And what that does to oil prices, well, at least for now, obviously, oil's still struggling at about $70 a barrel. So I don't see a whole lot of U.S. producers starting to increase production just yet in light of the broader increases in oil production that OPEC has been promising.
You mentioned your forecast for gasoline prices over the course of this summer as well here in your anticipations. We know in the most recent CPI May reading that the energy index declined 1%. Gasoline index fell over the month here. What now should we be looking out for, as those readings were well before this latest spate of conflict?
Yeah, I'm not expecting a whole lot out of this latest minor increase that we're expecting here in gas prices. Keeping in mind that gas prices, and CPI looks at year over year, keep in mind gas prices still 10% below last summer at this point. So that's the terrific news, is the national average, not only for gasoline, but diesel. Diesel also just hit its lowest level since 2021, prior to the escalations in the Middle East. So, I mean, we're still trending very good. Gas and diesel prices still quite a bit below last year. So I still think we have a lot of room, even for prices to go up modestly here over the next week or two. Eventually, I think they will go down. All in all, not going to be a major hit on energy prices just yet, as they remain far below last year.
Patrick, great to see you as always. Thanks so much for the analysis.
Thanks for having me.
Certainly. Coming up, Yahoo Finance markets and data editor Jared Blickery breaks down the case for a dovish Fed pivot. That's next.
The Fed has a big decision to make this Wednesday. Odds of a rate cut, well, they're pretty low. But we've got a couple charts suggesting that there might be a series of rate cuts later this year, not just a one-off. I'm Jared Blickery, host of Stocks in Translation. Here's the simple big idea from Alfonso Pecatiello of the Macro Compass, also known as ALF. First, inflation right now is even cooler than it was back in the summer of 2019. And why are we talking 2019? Because that is exactly when Fed Chair Powell took his last big dovish turn before the pandemic. Now, back then, the Fed started slashing interest rates from 2.25% all the way down to 1.5%. But since then, inflation, well, guess what, has been averaging 0.21% over those 3 months versus 0.14% currently, so a bit lower than it was back then. So it's surprising to me to learn that the Fed lowered rates while inflation was running a little bit hotter and employment even lower than it was today. In other words, right now, inflation is less of a threat and jobs are less stable, but the Fed is still a full 200 basis points tighter. Now, let's look at this key chart from Wisdom Tree that ALF helps break down. It compares core CPI inflation using the latest government measure in white versus a real-time measure of housing inflation in blue. And notice how the blue line, the real-time gauge, rose much more than the government measure in 2021 and 2022. In particular, look at that huge gap in mid-2021 that is circled in red. The housing market was already red hot, but the official number, it didn't show it yet. That delay tricked the Fed into raising rates a little bit too late. But then look at the green circle from late 2023. It is the exact opposite. Real-time housing inflation fell quickly, and the core number has been under 2% for a year and a half, meaning the official measure has plenty of room to potentially keep falling. Quite simply, this chart is basically a green light for the Fed to turn dovish. So, if the Fed goes soft and the dollar drops, how do you trade it? ALF says short the denominator, aka the dollar, and go long the numerator. And let's break down what this equation suggests. Investors, well, let's take a look at this. Sectors and even entire countries with pricing power, real pricing power, are what he likes. U.S. large cap tech falls into this group, so as rates fall and duration shrinks, the Mag 7, guess what? They could rise to dominance yet again, and especially NVIDIA. Also on the menu are commodity countries, so think Australia, Canada, Brazil. They could get a lift, and Chile comes to mind as well with its gold and copper mines. And if you want the pure hard asset hedge, you can go outright gold and silver ETFs. The more industrial metals like platinum and copper, and also palladium, they could also follow. So bottom line, the Fed is probably going to sit tight this week and wait a little bit longer to gauge the true inflation pass through on tariffs. And few on the street are expecting more than a single rate cut anytime soon. So this call is a somewhat contrarian play, meaning be careful with your conviction and keep risk management top of mind. So make sure to tune in to the big Fed decision this Wednesday. We'll get a fresh set of inflation, jobs, and growth projections from all the FOMC members. Probably no rate cut just yet, but pay close attention to Powell's tone in the presser and look for subtle signs that he might have rate cuts on his mind. And tune in to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you. Now time for some of today's trending tickers. We are watching Meta, Reddit, and Victoria's Secret. First up, Meta shares are higher after announcing ads will finally be coming to WhatsApp. It's the first time that ads will appear on the messaging platform, but only in one section. The tech giant says it will collect some data on users to target ads, including location, but will not touch the content of messages. That was a major point of contention, at least among users who were saying, okay, how much of the message content are you actually going to be analyzing in order to serve up ads that are most relevant to us as well?
Yeah, that could be a concern because that's absolutely the way that they market it is we cannot see what's there. Ultimately, to do targeting ads efficiently, we need to understand what's being talked about. So that absolutely raises a question. And what's important is end user adoption. So if that impacts that, we need to make sure there's follow through with ad revenue spend. But I find more interesting with Meta is this shift to the artificial general intelligence and the race to artificial general intelligence and that move they just made to assemble that team, putting Llama on the back end. And that to me is the bigger revenue driver or opportunity for Meta.
It's a huge opportunity, especially as you think about the number of creators that are on these platforms, the number of businesses that want to leverage more of the tools as well. And the generative AI component, at least at the lens level that we can read through right now, is trying to figure out, okay, how will this be able to make sure that it can make everything from ad creation in platform all the way to the experience for users who are creating their own content that much easier. And I think we're extremely early innings, maybe still in batting practice.
Oh, we are absolutely on those early innings, but it's the race to artificial general intelligence. And what I find so interesting, it's game theory, where these hyperscalers are spending so much money. They just want to be in the game, but they don't know what the prize is. But if you think about technology, if you've ever worked in technology, effective technology is open source and iterative. So if we have more minds come in, he's assembling the team, iterative as in we're going towards the goal. We may not know what the outcome is, but it's an agile process where it's constantly evolving. So I think it's going to be interesting because we actually don't know what the prize is, but that's where the money's being spent, and we'll see how it translates into ad revenue.
Absolutely. We're going to be watching that one. We're also watching this one here today, Reddit. This is a huge one, announcing new artificial intelligence-driven advertising tools for brand management and engagement. You sense a theme here on the advertising front? The social media platform sharing these Reddit insights will allow marketers to identify trends easier and test new ad campaign ideas. Reddit shares, they're moving higher by about 5.9, nearly 6% on this news. And we were talking about this in the break because this was largely expected for the moves that Reddit was going to make, making sure that its conversations on platform that clearly display how human-to-human engagement online can also inform some of the ways that generative AI can almost sound more human or anticipate where there can be that layer of, okay, so you want to sound nicer. Well, this is what nice people sound like when they're writing an email message. And now how that leverages itself in the data for advertising is what Pinterest, well, all of them, but Reddit especially in this case.
Pinterest definitely led the way. Well, and I think it is interesting because we think about targeted ads. We were just talking about understanding what the context of the conversation is. Now it's very targeted, personalized ads. When I worked at Merrill, actually, we designate clientele based on personas and speak to them differently. So now we could speak to them differently, sticking to tone, which would be effective advertising. But what I find interesting with Reddit, their Q1 numbers were really good. They're very new public company. Ad revenue alone was up 61% year over year based on the previous quarter. That could only be amplified with effective targeting. So it's going to be interesting to see how that plays out.
Up 171% since the IPO, all time here, but one thing that we do have to note, they are down 25% year to date. So got some ground to make up here from coming off of those highs. Lastly here, we got to talk Victoria's Secret. Victoria's Secret facing a battle with another activist investor. Reports saying Barrington Capital has 1% stake in the company and is pushing for board overhaul and a focus on the core bra business. This follows a similar move from BBRC International that took place earlier this month here. We're taking a look at shares of Victoria's Secret. VSCO is the ticker symbol there. It's higher right now by 3.7%. And we should also remember that the company actually had to delay the release of its most recent quarterly results because of a broader technical and online issue.
They did.
And so moving through that cybersecurity incident and now trying to figure out how they are still engaging with the consumer, that is being far more choosy about those discretionary dollars.
Yes, absolutely. And that's going to be the big issue for them. What I do think some silver lining would be is there was some recent leadership changes, and it was the person actually from Fenty, which really battled Victoria's Secret and won over that demographic. So hopefully there can be an adjustment due to that leadership change, but it's a marketing issue which was only amplified by that technological issue in cybersecurities, and they need to differentiate themselves from Pink and Victoria's Secret. And we have a very different consumer. We have a different market. We have a different consumer. We have different Fed framework. There's a lot of changes happening within the overall environment.
Yeah, absolutely. They talked about some of that consumer confidence and the economic conditions that they're continuing to navigate through here. They acknowledged that within the most recent quarterly results here, saying that they got to remain disciplined on the fundamentals and the execution of that with this macroeconomic backdrop.
They do.
We're going to be watching this closely. You could scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up on the other side of this break, we've got much more catalysts, all your market action ahead. Stay tuned. The Paris Air Show kicks off Monday. The aviation industry trade show expected to be muted this year. It's overshadowed by an ongoing conflict between Israel and Iran and a deadly Air India Boeing 787 crash. Boeing CEO has opted to skip the event in light of the recent tragedy. And with more on what investors can watch for this week, we've got Nicholas Owens, who is the Morningstar equity analyst covering aerospace and defense. All right, so let's just lay it on the table here as we're thinking about what this year's event, which a lot of these companies typically rely on, whether it be airlines, whether it be the aircraft manufacturers, defense companies, they rely on this for announcements of major deals. What's this going to look like versus years past?
Thanks for having me, Brad. Well, it does seem like, especially with the CEO deciding not to go, that they're just sort of taking a, let's say, a more low-key presence. Maybe it would seem inappropriate to be kind of, selling and marketing and glad-handing in light of the tragic crash. My expectation, though, is that a lot of the plane orders and the types of things that you would see announced have already been, being worked on in the background, and they'll likely still announce them. They may not have quite the splash. That's all.
That's a great point as well, especially considering how long it takes for some of these deals to actually come over the finish line. And this is typically just the time period where we see the wave of announcements come forward. But all that considered, we have to think about what the year in aviation has been like, whether that be in some of the issues with air traffic control, some of the painful traveler experiences, and then additionally starting off the year with some crashes that really took headlines. So how do entities come out of an event like this and signal kind of the all clear, or at least where there are being significant steps in the right direction for the aviation industry at large?
Well, I think your question is really interesting because you have, let's say, a whole list of things that, incidents and headlines and lists of concerns that travelers have, some of which relate to staffing at the FAA or air traffic control or infrastructure around, this radar tower in Newark, that are really not under control by a Boeing or an airline. And so they, in a way, have to kind of again sort of be a little bit low key and sort of say, well, we'll work with our partners at the FAA, and we support our customers to make sure that everything is safe. But in this case, for example, Boeing can't really do anything about the radar at Newark. So I think the way you frame it as the aviation industry, which kind of has a lot of players, including these airport infrastructure and government entities, they're all kind of under scrutiny, I would say.
Yeah, and you're right to make the point that it is issues in some cases that are out of their control. When I was speaking with Delta CEO Ed Bastian at the beginning of the year, he was talking about how he would like to see the current administration here in the U.S. making more investments into key infrastructure at the FAA level, down to air traffic control and so forth. As we're hearing from some of the deals that are coming forward and announced right now at the Paris Air Show, this one did come up this morning where we know a subsidiary of RTX, one of the segments within RTX, they are going to get now an order from Frontier Airlines, and this is key because it's related to that A321neo, which is seen as kind of the Boeing 737 MAX closest competitor here, because it's highly profitable and the margins look good on that. What is the significance of that for RTX, which in itself is looking across some of the other elements of its business and knowing that this is a key time for RTX as a name?
Yeah, so I presume you're referring to an engine order where on the A320 family, including the A321s, airlines have a choice of a GE or CFM engine and the Pratt & Whitney engine. And they usually make those choices based on a handful of things like the economics of running the engine. It also has a lot to do with where they're going to operate. So in harsh climates, people have been, I think, favoring the GE engines. And so it's a good order, for Pratt. That engine had some maintenance issues and a recall, but here you see that the product is still in demand. And so that kind of gives me, it's an endorsement that the franchise around, commercial engines at Pratt isn't damaged necessarily.
As we're thinking about RTX, I'm taking a look at the stock right now. And over the past 5 days, it's up by about 4.3%. Of course, one of the considerations that we have to raise is that this is a core defense company, especially in times of conflict, that tends to have some investors start to trend towards that as one of the plays within their portfolio. I wonder what you're tracking here on this front, especially at a time where some of that geopolitical conflict is leading to entities, companies at the Paris Air Show having France close Israeli company booths, given the diplomatic disputes that are playing out.
Yeah, I mean, there's a lot there. So RTX is about a 1/3 of a defense franchise and mostly commercial aerospace, but it has benefited from this kind of uptick here since last week. I do want to make a comment about the let's say the habit or the pattern of investors to go buy defense stocks when fighting breaks out. I think probably the most logical connection between that is simply that things also happen when fighting breaks out, like oil prices spike, like you were talking about before, and defense stocks don't tend to have the same macroeconomic exposure. So it's more of a safe haven bet, I think, than I don't see any strong connection between fighting breaking out somewhere and the actual bottom line of these companies. If anything, if you have a prolonged conflict, it could jeopardize military budgets and spending on the kinds of things that these companies make their money on. And then, you'll have the story of, let's say, anti-missile, defense systems or munitions being resupplied. Those tend not to be a huge piece of their portfolio. So I think it's more of a flight to safety or kind of a by the geopolitical tension. And I would argue that we've been at a pretty heightened level of geopolitical tension for years. And so the uptick from here on geopolitical tension isn't more geopolitical tension. It's combat, which is alarming.
Absolutely. Nicholas, thanks so much for taking the time here with us. Some really key insights and analysis. Appreciate it.
Thanks for having me.
Coming up, why the latest economic data could be good news for international investors. That's on the other side. Chinese retail sales rose more than expected in the past month. A National Bureau of Statistics spokesperson attributed the spike to stimulus like the Consumer Goods Trade-in Program and the upcoming 618 shopping festival. But challenges to the Chinese economy, including persistent inflation and trade uncertainty, that, still persists. With industrial growth slowing from April. For a read on what this means for international investors, I want to bring in Jay Poloski, who is the TPW Advisory founder. Good to have you here back with us. Just take us into your read-in on some of the data that's come out from China on the consumer right now and some of the retail spending that we were seeing.
Well, Brad, I think it's pretty clear that China understands its export dependency on the U.S. consumer is kind of a strategic risk. And so they're trying to offset that and hedge that by stimulating their own consumer, who, really has been in the doldrums since COVID, right? So if you look at the U.S. consumer the last couple of years, record high stock prices, record high house prices, compare that to the Chinese consumer, where real estate has been in the doldrums for 3 or 4 years. Stock prices have been weak for the last couple of years. So consumer confidence in China has been flat on its back. And really, that's the effort that the government is trying to stimulate using fiscal stimulus, which China has plenty of space for, very importantly, as does Europe, plenty of space to use fiscal stimulus to try and support consumption, particularly around big ticket items. So I think of, washing machines, dishwashers, refrigerators, things of that nature.
Jay, I've been trying to read through some of the IDC data that is really tracking across the smartphone market, especially to see how U.S. companies are holding up in China, especially knowing that the U.S.-China tensions have fueled some unsettling news for those U.S.-based companies. And it kind of triggered the question as we were reading through this data in our morning meeting, trying to figure out the biggest winners and losers of a spending consumer in China.
Well, the biggest loser is Apple. Right. I mean, clearly, the U.S. has made it clear to China that it's walling off the U.S. Tech space. China is now doing the same to U.S. companies. So if you look at Apple, I mean, it's as simple as just punching up the Apple chart. One of the worst performers in the tech sector in the U.S. because it's dependent on Chinese consumption. And Apple is plummeting down the ranks of best-selling smartphones in China, with Huawei, the domestic producer, dominating the space. You see the same thing in EVs, right? Where Tesla a couple of years ago was a market leader in China in the EV space. Now it's barely top 10 as BYD and Geely and others dominate the space. So, China is a very successful practitioner of industrial policy. And they have mastered that through the drive to conquer the renewable space, which they now do. They control and dominate the entire renewable energy space. They're now pushing that into robotics and advanced manufacturing and tying that into AI to become, a really important player globally. And so it's one of the markets we're most keen on. We're overweight Chinese equity using U.S. listed ETFs, which is what we focus on. And we have been overweight Chinese equity for over a year, and we expect it to continue to do well. We like emerging markets more broadly. We think the setup there is extremely attractive, and we're quite constructive on what we call the global growth long cycle that we think will extend through 2027, 2028, and perhaps into the end of the decade.
I wonder how and after we come off last week, which was a week of some of the treasury auctions that were taking place, I wonder how you're reading through some of the international purchasing that's happening and ultimately the demand appetite for international investors investing in U.S. bonds and then vice versa as well, where you hear about some of the U.S. firms that are trying to make sure that they have international exposure right now.
Yeah, no, these are the key questions, Brad. If you're a global macro investor, as we are at TPW Advisory, this is really the heart of the matter. And last week was a great tell, right? When you have a surprise hit the markets, as we did on Friday, to watch how the big cross assets, stocks, bonds, currencies, how they react is really telling. And last Friday was extremely telling, right? You look at the dollar, no reaction, right? The dollar was actually down last week. It's at a 3-year low, so no bounce whatsoever on any kind of safe haven. More importantly, to your point and your question, look at the Treasury market. No rally in Treasuries last Friday, or over the weekend. So that is telling you as clear as day that domestic and foreign investors have no appetite for adding significantly to their Treasury positions, to their dollar positions, or to their U.S. equity positions. The U.S. has been the place to be for the last 15 years. It's priced at a premium. You have massive governance questions around the Trump administration, massive questions around taxation, tariffs, you name it. How does that fit with a premium valuation? The answer, it doesn't. And so the opportunity set has migrated. We believe we're at the beginning of a secular leadership change in global equities away from the United States to the rest of the world, fueled and supported by what we think will be years of capital repatriation out of the United States, back to Europe, back to Asia, back to emerging markets, as countries recognize they need to fund their own efforts in AI, in climate, and in defense.
And so, Jay, as we were talking about earlier on in the hour, there is now more modeling around what the long-run tariff rates expectations are from major institutions. What are you modeling for? What are you anticipating?
Well, we're not really big on models here at TPW Advisory, Brad, to be honest with you. We're kind of a little bit more old school, but we expect that, look, the bottom line is the U.S. has a government that is a uncertainty factor that continues to press on the uncertainty edge, right? We're now talking about another Liberation Day where the president's going to simply put his number on a piece of paper and send it to people. So look, that's just not how folks want to play the game. And so the rest of the world is going to work around the United States as opposed to being part of the United States. And if we end up with an administration that is in power for the next several years, we believe that at the end of this decade, the gap between where the U.S. is as a competitive global economic power versus Europe and versus Asia, and particularly China, is increasingly wide and not in favor of the United States, because the U.S. is going backwards on EVs, backwards on industrial policy, whereas Europe is stimulating, using its fiscal stimulus, recognizing it has to spend in its own defense, building out its AI capacity. And China is doing the same and is basically sewing up Asia.
Yeah.
The president of China is going around to Malaysia, Cambodia, et cetera, saying, we want to do business with you.
Right.
The United States is adding 45% tariffs on them. Which would you choose?
Jay, all great points. Good to have this conversation with you. Would love to keep it going. Got to have you back.
Thank you, Brad.
Thank you. We've got all your markets action straight ahead. Stay tuned. You're watching Catalyst. Our very own Brian Sozzi is out in France for the Cannes Lions 2025 International Festival of Creativity. Sending it over to him for the latest out of this iconic event.
Joining me now here at Cannes Lions is Time Inc. CEO Jessica Sibley. Jessica, always nice to spend some time with you in general, but of course here at Cannes Lions. And there are a lot of major moments here in the media industry. What are some of the early surprises you're hearing and seeing on the ground here?
Well, it's day one, so not too many so far, but thank you for having me, Brian. It's always great to sit down and talk to you in this incredible setting, and it's going to be an amazing Cannes with lots of conversation, and I'm excited to be here.
The one big theme from what I've been able to tell, I've been here a day and a half, it's AI and how AI is going to change the advertising industry, but it's also changing the media publishing industry. How are you embedding it into what you do at Time?
Well, AI is everything, and the conversation that's happening, I think, every day here in Cannes. We're really proud of everything that we've done to lean into AI. I would say our journey is in maybe chapter 2. We started early in this journey, and we've decided to start with a guiding principle, which was, are we going to negotiate, litigate, or do nothing? We decided that we were going to negotiate, we were going to opt in, we want to be part of this technology, part of what's happening across the media industry, across consumer behaviors, and we've done a lot of things to get us to where we are now.
A lot of your competitors have taken the opposite approach. They want to litigate AI. What's your advice to them?
Well, we're on our journey and our path, which is Time AI. We launched that. We started the process about a year ago. We wanted to create a version of Time for agentic AI, and we actually RFP'd 12 different companies. And we landed on 3 finalists and selected Scale AI. I know you've been covering this story with the $15 billion investment into Scale. We decided to partner with Scale to develop our sort of phase 1 of Time AI, which was a version of Person of the Year that Scale built for us. They indexed our entire 100 years of archives and trained a private LLM. We launched with our Person of the Year. We knew the optics would be big with President Trump, and we went back and trained the model on 4 recent Person of the Year, so Zelensky, Elon Musk, and Taylor Swift. What does that mean? The acceleration of how consumers are demanding intentionally finding ways of personalized content, multimodal content. And with the AI answer results, we wanted to, again, embrace it and be part of it as opposed to litigate. So the output of that was Time AI Person of the Year. You could translate it, you could summarize, and podcast is really the audio version. So an audio version of that content. And we're continuing on that journey where we'll be launching several other new initiatives with Scale.
Can you take us behind the scenes on some of these new initiatives? For example, I saw a release from you recently, an AI podcast. What is an AI podcast, and then how will AI appear on Time Inc. later this year in different and surprising ways?
Well, it's really an audio version. It starts with training the LLM private for safety and security and protection of our IP, which is our journalism, not just of what we do today, but over 100 years. And the consumer expectation is change, and it's accelerating really fast. Sophistication, dynamic, real-time results, and multimodal and personalization. So really the output of our content, which we're launching with an audio version of the newsletter, The Daily Brief, which is our largest newsletter in terms of size of audience, where we take 4 of the top read stories on our homepage and we create a toolbar. And you can listen to 1 story, 4 stories in a 5-minute version or in a 10-minute version.
That's cool.
And we were very intentional about training the voice. So a little bit back to our history, we have Henry and Lucy, Henry Luce, and a lot of enjoyment out of content is summarization, text, video, but audio. And we can create all of that, again, partnering with Scale.
Brian, thanks for the interview. Appreciate that. More from Cannes this week. Also, we're tracking oil prices. They are easing further this morning. The Wall Street Journal reporting that Iran is signaling it wants to negotiate with Israel and de-escalate attacks here. There you're seeing the impact that it's having on oil prices here for crude and, Brent and WTI here this morning. Jessica, you've been tracking the energy price fluctuations, oil price fluctuations. Wonder how you're reading into this.
Yeah, so one, it's great to see that we've got some more certainty. That seems to be the pattern lately. Yeah. We have some uncertainty, we react, we can draw levers there, and it's the velocity of changes that's important. The component with oil very specifically that I think all investors should be aware of is if we were to plot a chart of energy versus WTI, all of a sudden we see this divergence. It used to be very correlated. When oil is up, energy also follows. That has changed. Energy's declined, it's helped with the inflation picture. Oil's declined, helped with the inflation picture, but energy has been going on the opposite direction. So I actually think there's some opportunity to add some more energy to our portfolio right now, some quality, even get some dividends. But it's the velocity of changes, as we've been discussing, which is very important these days.
Excellent breakdown. Jessica, thanks so much for joining us this hour as our guest contributor. Stockbrokers.com, of course, and you can check out her insights there. We appreciate you.
Yeah, pleasure being here.
Coming up, everyone, we've got wealth dedicated to all of your personal finance needs. Ali Canal has you for the next hour. Stay tuned.